isolated. Sorry about that. It's not really an isolated failure, but more of a systemic vulnerability. And we wanted, with the help of GOGLA and also Altai Consulting, to translate these learnings to practical actions that companies can actually take to mitigate this on the ground. And the second biggest factor that motivated us is also to enable this sort of a vertical dialogue between funders, companies, enablers like GOGLA, so that the ongoing programs that we have can also be positively impacted on a programming level by the insights that come out of studies like this. It's been a very insightful journey, and we're more than thrilled to support the study and the insights that came out of it. And leaving the rest to the experts on the call, and we're very curious to hear your thoughts on the findings. Thank you so much, Anne.
All right, thank you so much, Gopika. Really appreciate that and kicking us off. So I'll just welcome Guillaume and Björk now to share the screen and kick off the presentation.
Great, thank you very much, Anne and Gopika. So hi everyone, I'm Guillaume de Choisville from Altai Consulting, and it's our pleasure with my colleague Briac to present the results of Keeping the Lights On, which is a deep dive into why customers struggle to repay their Pegos alarm system, but also about what the sector can do about it. So in terms of agenda, it's structured into three parts. First, I'll briefly introduce the context and methodology of the research, why and how we did this work. Then Briac will present the main insights, focusing on what we learned about who struggles to pay, why and what patterns emerge. And finally, I'll walk you through our recommendation, not just for companies, but also for the broader industry and for development partners. On the next slide, on the context, I'll go quickly, as I believe you're already very familiar with it. Over the last decade, Pego Solar has transformed energy access in Africa. And today, Pego remains a core technology to reach SDG 7. But we also must face some uncomfortable truths. After a period of regular growth, excluding COVID, by 2023, this growth had stopped, and repayment issues remain widespread. The recent market trend report showed that as of 2024, 1 in 4 Pego customers struggled to make regular payments, while it was 1 in 5 in 2020. And without solution to this issue, the sustainability of the entire sector is at risk. So, to understand what's driving these difficulties with repayment, but also identify some best practices for default management, GOGLA, with the support of RVO and Endev, commissioned a comprehensive mixed method study. So, for this research, we focus on customers who struggle to pay, i.e. who paid less than 66% of the amount due in the last 90 days. So that was the definition for those who struggle to pay. And we focus on smaller tier 1 systems, so from 3 to 20 watt peaks, which is the typical entry point. We looked at 2 customer groups, the new customers, so in their first 3 months, and the old customers who had owned their system from 10 to 15 months. Overall, we conducted more than 2,600 quantitative interviews with customers who are struggling to pay. They came from 3 companies, and we thank them for their participation. It was Delight, Sanking, and Engie. And we also conducted 12 in-depth qualitative interviews with users to help us understand not just the what, but also the why behind this behavior. On top of this, we also integrated insight from 5 Pego companies to better understand the types of processes in place to deal with customers who struggle to pay.
Thank you, Guillaume. So allow me now, hello everyone, this is Brian from Altai Consulting. Allow me now to shed light on the main insights from the research. Obviously, we won't be covering all of the points from the eventual report, which should be out this week. We're really focusing on the main elements. Maybe first, a general view. Non-payment of solar home system is something that is quite significant. You can see here in the graphs that more than 40% of customers in both Kenya and Uganda, which were the two countries studied, show struggles to pay. And what we mean by struggle to pay is that they have been paying for less than 2/3 of all days. What's interesting here is that there's a clear link between the timeline, how the tenure of clients and their payments. And what's especially interesting here is that you can see a clear difference between new clients, i.e. clients which have been paying since less than 3 months, and the older ones. Starting from 4 months to up to 12 months of repayment, you can see that it tends to stabilize, meaning that possibly, and this is one of the main elements, that those 3 months are really keys to understand and manage non-payment of SHS. If we now focus really on the root causes of non-payment, eventually the study shows that the main issue at core for non-payment is financial constraints. In both Kenya and Uganda, and when talking about new customers and older customers who struggle to pay, eventually the issue is that their income is too unstable, or they have other financial priorities. Still, and what's interesting here is that these motivations tend to compound with other issues which are faced and which we'll detail out just after. Having alternatives, facing technical issues are among also the most important ones. If I want to talk first about the financial constraints, the issue at core is that the clients and the customers who struggle to pay, most of them have super unstable incomes. Only a minority of customers report having a stable income. And this also ties with the issue of seasonality. We're talking about a lot of customers which are dependent on agricultural work, either directly or indirectly, and so suffer during some seasons. Additionally, we've seen issues of debt being quite common, with more than 40% of customers claiming to be customers who struggle to pay, claiming to be indebted in both countries. In addition to these unstable incomes, what's interesting is that most are also regularly hit by external shocks. And here, these shocks tend to vary. We're talking about unpredictable expenses for the household, medical expenses, family obligations, business setbacks. But we're also talking about macroeconomic shocks, inflation, 42%, especially in Kenya, this was the case, and 42% of the Kenyan with whom we discussed mentioned that they faced a severe impact of the inflation. The inflation caused a severe impact on their ability to repay for the SHS. Climate events, and especially droughts or floods, which more than 50% in both countries of clients who struggle to pay have faced, affect their yields, affect indirectly the available income of the customer, and therefore their ability to repay for the SHS. In addition to financial constraints, we studied the need for SHS, and here there's multiple points which are interesting. The first one is the use of alternative. What's interesting here is that, especially in Kenya, a lot of customers who struggle to pay have alternatives that are connected to the grid. It's nearly a third of all customers who struggle to pay in Kenya, much less in Uganda. This leads to the SHS not being used as the primary source of lights or electricity, but solely as a backup, which causes, disincentivized to pay every day for the SHS. Still, on the question of use of alternative, what's also interesting is that not all alternatives compete with the SHS. In practice, a lot of the other alternatives, especially kerosene lamps, do not replace the SHS. The SHS is more powerful, safer, and cheaper in most cases. Another point that was really interesting talking about the needs is the multi-SHS ownership. A third of all the interviewed customers in both countries have multiple SHS, and here it's normal SHS, GOGLA affiliated SHS, and also solar lamps. More interestingly, 10% of all the clients we studied simultaneously pay for multiple SHS at one time. This is because the first one they bought is not performing well, because they have multiple electricity needs, because they have an SHS at their home and also at their shops. But this leads to a limited need to pay for this particular SHS, which we studied. In addition, finally, on this need for SHS, something we did not plan for at the beginning of the study is that traveling is also a good reason for not paying for the SHS, because it leads to reduced needs in paying for it. On technical and network issues, what was particularly surprising here is that a lot of customers mentioned having faced some kind of technical issues. 30% in Kenya, 50% in Uganda. These issues, in most of cases, were issues with the charging, the charger weakening across time, and also, which was quite common, being locked out of credit, not receiving their token. These are issues which tend to persist, which do not directly prevent the customer from using the HHS, but which compound and lead to clear dissatisfaction. And so eventually this can just refrain from repaying for the system because the system does not become a priority with their issues. However, what we also noted is that mobile network issues, mobile money knowledge, it does not appear to be a key reason for not paying for the HHS. 90% of customers are able to pay on their own via mobile money. Most customers live close enough to a mobile money agent, and network issues, recurring network issues, is quite rare. It impacts less than 10% of the customers who struggle to pay. I'll be stopping here to study case by case these issues for non-payment. Maybe an additional one, and you'll have others in the eventual report. But we also studied for customer onboarding, and what was quite interesting here is that most customers provided quite positive feedback and showed quite a good understanding of how the paygo system works. However, they also showed quite low awareness of their remaining balance, the number of days they still had to pay, and the amount they still had to pay for their SHS before they own it. Before going to the recommendation, finally, we used this research also to leverage this research to discuss with 5 companies and to understand their widespread company practices to deal with non-payment. We noted 3 main reasons. The first practice is currently most companies have 2 regular outreaches during the client onboarding. Usually it's one just after the purchase during this grace period to ensure that the client understands how the paygo system works. The second one is just before the payment, just to remind the client to pay and check also for any issues with the device, and in which case these issues become the priority for most companies with whom we discussed. The second element is that most companies have adopted this client tiering system, measuring the customer repayment through most of the time the collection rate, payment versus expected. And then these results are transferred into a tier system with different management of customers based on their repayment. So good customers get suggested larger products, while problematic customers are handled differently. And this also leads to my final point. Most companies right now have already adopted escalation matrices, which tend to vary depending on this repayment tier. And here I've noted a standard approach with starting with SMSs, then phone calls, and then field visits. Additionally to those 3 best practices, we noted one additional one, which we'll cover during the recommendation. It is about agents being incentivized based on the repayment performance of their customers. But Guillaume will talk about this in the recommendation directly.
Thank you very much, Briac. So now let's move to the recommendation section. This recommendation covers 3 distinct levels. First, the company level, so focusing on what paygo provider can do directly to improve repayment outcomes. Second, the industry level, where sector-wide collaboration and standard can improve market functioning. And third, the ecosystem level, where donors, policymakers, and other partners can address affordability challenges that no single company can solve alone. Again, since we have 20 minutes, it's fairly high level, but the report provides much more details, as well as some resources for stakeholders to address the following recommendation. So let's begin with the company level. The first recommendation at the company level focuses on improving the KYC process with particular attention to income and needs assessment. As the research showed, 2 factors consistently drive non-payment: 1, income instability, and 2, a lack of consistent need for the Solon system. The most common reason is that customers have alternatives, such as the grid connection, but there can be more complex reasons. For example, in some cases, the paying customers is not using the product, multiple people contribute to payment, the Solon system is shared between several households, or customers sublet their Solon system to others. All these elements are critical to assess during the KYC process, both to decide whether to proceed with the sale, but also to ensure the escalation strategy, to ensure that this escalation strategy is relevant. So while we fully recognize that enhancing KYC can be costly, especially for smaller systems, it should be viewed as an investment in portfolio quality. So KYC questions should be expanded to cover the current energy sources and how the Solum system compares in cost and utility. Then who will use the SHS, when and for what purposes. Also the ownership of other Solum system or lighting sources, and patterns like frequent travel that could affect usage or payment. This is important because a financial difficulty or setback may be temporary, while the presence of alternative products is likely to be more systematic. Then our second recommendation addressed a critical structural issue, which is staff and agent incentives. The discussion we had with several companies in the industry showed that there is a regular misalignment in the incentive scheme. Sales agents are usually rewarded for the quantity of sales, not the quality of customers they recruit. And call center agents typically operate under task-based system rather than managing a customer portfolio over time. And this disconnect can lead to sales being prioritized over sustainability, and also customers lacking consistent, knowledgeable point of contacts over time. So companies should tie sales agent incentives to customer repayment performance over the longest feasible period. We know that it can be difficult in practice, but sales agents whose customer maintain good repayment behavior should receive the best commission. Tying sales agent incentives to the repayment rate of users during this initial period, so typically the first 90 days, as we discussed, encourages better customer selection and onboarding, and also better support in the multiple touch point at the beginning. For customer care agents, they could act as credit officer. In such a, let's say, portfolio management model, these agents follow clients through their full life cycle and are in a better position to identify the best solution to their issues. So there could be also potentially incentive scheme for them that would reward long-term repayment outcomes and not just task completion. Then the discussion with companies and data from Pego Labs also shows that the first few months of SHS ownership are highly predictive of long-term repayment behavior. So customers who struggle to pay from the outset tend to continue facing difficulties. And conversely, strong early repayment correlates with good performance over the full contract period. So this leads to several recommendations. Design a structured post-onboarding process for new customers with clear outreach strategies, such as welcome calls, early payment reminders, and technical support. Then a proactive identification and resolution of challenges faced by new customers by understanding the root causes of these challenges. And the resolution of these challenges should be the highest priority to deciding on the type of escalation strategy. And eventually, close monitoring of repayment patterns during this critical period. For customers who show early signs of repayment difficulty, companies should consider then adapting engagement strategies. So, of course, again, this has a cost, but this initial period is so crucial to set repayment on the right path that we've seen that companies that have implemented such changes had very positive results, and we're trying to implement touch-and approach in all their operation. So now let's move from the company-specific fixes to the industry layer. So the places where individual firms cannot fully solve the issue alone. Here you'll see that two themes dominate: common metrics and responsible data sharing. So the first one on company metrics clearly stood out during our in-depth interviews with companies in the sector. While every company collects repayment data, there is little standardization. Metrics vary widely, and data sharing across the industry is rare. So this creates a significant missed opportunity because without standard metrics or shared insight, companies are slower to react to market changes and also less equipped to improve credit management collectively. So there is a clear need to adopt standard performance metrics. Initiatives like GOGLA's PEGO Perform have started this process, but company alignment remains uneven, and ensuring a more systematic participation is therefore crucial. By standardizing key indicators and sharing data responsibly, companies can benchmark performance, identify emerging risks, learn from each other's experience, and it also reduces the due diligence cost when companies seek capital. Our research also highlighted specific data challenges around both agents and customers. Some of the behaviors of sales agents can impact both companies' reputation and clients' well-being. However, agents banned for misconduct can easily find work at other companies. On the customer side, there is also a risk that they misrepresent their situation during KYC, and this can lead to companies selling to risky customers as well as clients over-indebtedness. So while some companies work with local credit bureaus, data exchange remain inconsistent and often limited. And more generally, insufficient data on credit performance also prevents the ecosystem, regulators, associations from having an accurate picture of the sector. So two potential actions stand out here. First, creating a shared database of sales agents to help identify and exclude fraudulent or unethical actors. We're aware that there might be data protection regulation making it difficult in some contexts, but there should be at least more background checks with contact references, for instance. And the second one is expanding credit data actions with other market participants and credit reference bureau. Eventually, we can move to the very last one for the recommendation at the ecosystem level. The research made very clear that financial constraints are the leading cause of non-payment. But more stringent KYC procedures may lead companies to favor more financially secure, lower risk customers. And such a shift risks sidelining precisely those most in need to access to electricity, the core target of SDG 7. So the tension is clear. A sharper focus on credit performance inevitably excludes a large swath of the population. So subsidy standouts are clearly essential to bridge this gap, and they may need to remain in place for as long as the affordability challenge persists. The points on the subsidy design that you can see on the slide are mostly drawn from our discussion with companies. The first one is that subsidies tied to daily or monthly payments appear more effective, while those focused on down payments or extended loan terms have shown more mixed results. And the second is that result-based financing mechanism can align donor and company incentives by linking subsidies to measurable outcomes, such as customer repayment performance. Additionally, the sector should explore drawing more climate adaptation funding into the off-grid solar space, and also considering insurance mechanism to help protect vulnerable customers from climate shocks that reduce their ability to pay. Subsidy design and climate funding integration are complex and will require multi-stakeholder coordination, but they are critical tools for maintaining energy access for those most in need. So we've talked quite fast with a strong French accent, but now we're done with the presentation, and we'll be happy to answer all the questions you may have on the research later on.
All right, thanks a lot, Guillaume and Briac. Really appreciate you highlighting the study findings. So I now want to welcome Oliver, that has set the stage for the panel discussion that we are just about to get into now. So Oliver, over to you.
Thanks a lot, Anne, and thanks a lot, Guillaume and Briac, for the presentation. My name is Oliver Reynolds. I'm the Senior Manager for Insights and Data at GOGLA, and I will be moderating this panel today. Let me quickly introduce our panelists, and dear panelists, if you could turn your cameras on around now, if your connection is strong enough. I'll start with Harriet Nongula, Founder and Chief Executive Officer at Fina Solar. We then have Dan Waldron, whose camera I can see, Director of Insights at Acumen. We have Charlie Miller, Senior Energy Access Consultant at ESMAP. And last but not least, Donald Connolly, Director of Credit Risk and Collections at Delight. I'm going to go for a first round of questions where I'm basically going to ask you all to kind of share your initial reactions to the findings of the study or the findings in the presentation today. Donald, I'm going to start with you, as Delight was directly involved in the study, and also to start with the company perspective. From your, either from the participation in the study, the insights that were shared specifically with Delight, or the presentation more generally, what stood out most for you? Are there any of the challenges or any of the recommendations that really stood out to you or that really resonated with your experience in not only Kenya and Uganda, but across Delight's markets?
Yeah, thanks, Oliver. And firstly, big thanks to everyone involved from Altai, GOGLA, Endev for the support on this. I will say also we, as well as the specific insights, it was a fantastic opportunity just to see the depth. We don't always get this depth of kind of analysis and research on our own customers. So I really wanted to thank everyone for that. So yeah, what we took from it, we've taken actually quite a lot from it and adapted quite a few of our scripts, of our onboarding and our approach and process. One maybe thing that did jump out, well, the first thing that jumped out at me was, I think we've just touched on it there, which is that tension that we are very explicitly selling these products to the very, very poor. And I know in our, when we looked at our data, it was roughly 50% of the Ugandan cohort, and it was about 30 to 50% in the Kenya cohort, fall below the World Bank's definition of the extreme poor. So I think it's very worthwhile to say this is like difficult. We're lending to the extreme poor. So there's definitely always a tension then between, obviously we want to address energy access and we want to give these people access to light, to power, to like a modern way of living. But then I resonated with all of the findings that Guillaume went through there from a company level. At the same time and with the same breath, we also need to be then protecting the credit risk and the company's ability to be sustainable and to do this through the future. So for me, that's definitely a very big challenge, which is getting the balance right between delivering on the mission and expanding the reach and access to those that need it the most, while also living up to those high expectations that Guillaume put through, ensuring we know and are actioning all of those suggestions. So that certainly for me is the biggest challenge. In terms of what maybe we are doing and learning from that, we've definitely improved or are in the process of improving how we do an approach onboarding, where it isn't always possible to do a hugely comprehensive, in-depth survey like this with every customer when you've hundreds, maybe even thousands of sales happening every day. But we are trying to pick out what's the kind of the core here that we can scale and that we can build into our permanent operations, so that every customer does go through this level of kind of credit assessment and screening. And I think there was a question in the chat. Yes, there is times where we sort of know this at the start, but a lot of the times we don't. So the access to this type of data, and obviously, if we can get it, sort of validated third-party data is hugely beneficial for us to help make this decision better. And if we can't get access to that, we then have to generate it ourselves. And as we've talked about, or Guillaume mentioned, we ask the right questions. But I will say it's not easy. It's not straightforward that we can immediately know in advance, oh, this customer will struggle in 3 months and this customer won't. So I think we've certainly been on that journey, and I know we've been having support from the Paygo Lab in how to do that onboarding, to get the type of information that is required in the sort of efficient, least intrusive, and most scalable way, so that we can be making these decisions reliably, confidently, but also at speed and at scale. So there's certainly some of the challenges. But also, I really want to call out, there's some really interesting other insights that we don't always get, which I found most useful, just around how I actually was surprised at how different our two portfolios were. This is the same product, Kenya, Uganda, and I thought probably not going to be so different, but actually quite a lot different, where in some of, maybe I'll start with some of the surprising ones, where we saw that our Kenya customers were more rural, less well educated, and more impacted by the macro shocks. So even though Kenya as a whole may be more richer or economically advanced in some measures with Uganda, what we were seeing is actually some of our Kenyan D-series customers, some of are some of the most vulnerable. And while Uganda had a higher proportion of customers that were in agriculture, I think over 50% in agriculture, they lived closer to mobile money, they had less exposure to macro shocks, and more well educated. So that I thought was quite interesting, as well as the other interesting insight, which was around some of the social questions that were asked. We don't always ask all our customers, where, again, interestingly, Kenya had a slightly more positive view of non-payment than we were seeing in Uganda. Uganda was seen as, I think some of the words that came up in the raw data were like shameful and irresponsible, while in Kenya it was considered, look, it's a common struggle, everybody goes through it, this is sort of more socially acceptable. So these are the sort of interesting insights that we probably hadn't known or didn't get with our kind of day-to-day kind of dispositions or surveys. But yeah, really found them useful to understand just the broader context that we're working with.
Thanks a lot, Don. That was super helpful to also provide a bit more light on elements that we're not necessarily able to share today. And there was a question in chat just now. We will share this, the full report with everyone who registered to this webinar by email once it's ready. So you don't need to keep your eyes open for it will land in your Dropbox. I'll now switch to Harriet. Obviously, Harriet's the CEO of Fina Solar, a much younger company, much newer to the Paygo space. We've heard from Delight, one of the giants, let's say, in the Paygo space. We'd be keen to hear from you, Harriet, like from what you saw in the findings or the presentation that Altai did, are there any things that already resonated with you, or even maybe things that Donald said that resonate with your experience at Fina Solar?
Yeah, thank you. I'm really glad. I'm happy to be part of this conversation. And with Delight, Delight is the big fish. Anyway, I am Harriet, founder, CEO of Fenasola. We are still so young in the pay-go space, and we really still operate like pay-go and cash sales. Of course, the findings are real, and from whatever whatever from Delight has explained, the only difference is that Fenasola, we are still young, as I said, and for us, we are pushed in the pay-go space by these RBF projects. I mean, it's not something we would have gone for. It's not something that would have prepared like to roll out immediately, but because of the projects designs, the targets, and then the other companies are paying, offering favorable terms. There is no way we could dwell with that. So we just decided to go by it. One is experience about the know your customer, the great assessment of your customer. We find this a challenge because we work through agents. You know, it is a structure. We are at head office, you have your field staff, then they recruit the agents. Agents are at different levels, you know, literacy levels. And by the time they get to appreciating the whole concept, you know, of assessing a customer, some of them have not even yet really like appreciated it. For us, when we were designing our incentive to the agents, we tagged like for the initial deposit, it attracts a higher percentage, higher commission, and then the repayments also you know, of course, repayments, they are smaller, though we also give a reasonable good percentage. But now you find that the sales agent will rush out and they just want to push sales because they know that the more numbers I make, the higher commission that I get. And of course, these are agents from their own communities. You don't even understand the languages they are speaking. Yeah. So that assessment, knowing your customer, is not an easy thing. It's still a challenge based on the fact that the expectations of the company, they don't easily like they don't align with the expectation of the agent. Agent is waiting to earn a commission by selling volumes, for you want to really have a good sale. So that one is a challenge. We've had challenges, of course, the competition in the market. I see here in Uganda, where we have Uganda now, most of the pay-go business is supported by projects. You find that most of this business is projects and numbers. So for us, we are among those companies that I think are charging even higher initial deposits because our payments are monthly, and considering the cash flows constraint, so we reasonably charge a higher initial deposits compared to our partners, our other companies in the market. So what happens that as when Fenasola is in the market, I've gone to the customer and I've sold a product. We faced a challenge whereby we are implementing a project where I know Delight has also implemented it. This is the GIZ RBF, whereby the partner has a specific application where we are posting data. Like that is the Kobo Collect. And the design is that one customer should benefit from the project with one product. So if a customer, for example, buys a product from Fenasola at maybe has paid a higher initial installment one go, and then if by mistake my agent did not capture that transaction in the system immediately, you find another company will come in and give another solar light, another solar home system. They're like, okay, you will pay because they are on ground. So there is also that competition on the market.
Yeah, very clear. I think I would really want some of the other speakers on the call to come in on this question of RBFs and how they might play a role in all this. And I'll come back to you on that as well, Harriet. I just wanted to see on the beyond the RBFs, is there anything else that you wanted to add in terms of like findings from the study that really stood out? Maybe some of the challenges. I think you mentioned KYC, the challenges with aligning agent incentives. Those both really kind of align well with your experience.
Yeah, of course. Now, like the study being that the customers, their income, their earnings are not good. That is very true. Of course, a lot of emphasis is on the us solar companies or the impact those that are for lighting the world, push products in the market, push products to customers. But I don't know whether there's been an assessment of how much percentage a solar product takes compared to someone's income, to someone's earnings. So you find that people are constrained for sure. They have other needs, but now the light comes in, so they don't really have that. So to me, I feel that I wish that there could be also something to enable these the target customers maybe earn more so that they can be able to pay for what for their products. Yeah,
very clear.
I think
Yeah, very,
also
very clear.
what also has not been mentioned, there are some other challenges like it was mentioned that customers move. Yeah, customers move from one location to another, especially the refugees. Someone will be in Uganda today, the following day they are in Sudan. Yeah, and you call them and then their phones are off.
Yeah.
And also that we are still doing this pay-go manually. Another learning is that one of the factors also that contribute to non-repayment is that the way our agents present themselves when they are selling these products to the customers. Yeah, the customers sometimes are not well educated, and an agent may not also teach a customer how to make a payment. Yeah. So because they usually pay us through mobile money, but you find these customers who don't know how to pay using mobile money, and they always wait for an agent. So unless this customer calls office for guidance, that's the time you pay that someone is having challenges to pay you. Yeah, not that they don't have the money, but sometimes those challenges. Yeah.
Very clear. Thanks a lot, Harriet. And yeah, maybe I'll let Donald come on later on potentially some of the customer onboarding stuff and what Delight's been doing. But I want to give a chance to Dan and Charlie to also share kind of their immediate first thoughts on the results of the study. Dan, I can actually see you on my screen, so I'm gonna pick you first.
Well, I appreciate that. Lucky me. Thanks so much to GOGLA, to Endev, to RVO, to everybody. This is a really interesting study, and obviously to Altai for executing it so well. It was a little bit traumatic to read. It was a little bit going through all the issues in the model are right here, right? And there's a lot of them, and we all kind of know them, but seeing them all together, like the limited means to pay, the frequent shocks that people go through, the fact that it's not the highest repayment priority, how easy it is to switch, how many alternatives there are, all the technical issues of both the product and the payment, like they all showed up here in some way or another. And it was frankly helpful to see them all laid out, as Donald said. I mean, I'm not obviously as close, I should say. I represent Acumen. We're a nonprofit impact investor into many wonderful companies, particularly including Delight. And have done a bit of work on the credit risk issues in the sector, and have gotten to talk a lot with Donald and other wonderful risk managers. There were a few key tensions that jumped out of the report to me, and I'll try and hit them fairly quickly, and I'm happy to talk about what I think investors could do better. The key tension that Harriet just spoke to quite a bit, and I don't think we can talk enough about this. I don't know that we do have the right sales model for this industry yet. We've got a really good sales model to move solar product. I don't know that we have a really great sales model for financing durable goods to people who can afford to pay back for them. And if you look at all of the agent issues that crop up through this report, there's a lot. I mean, it's people who don't understand terms, people who say agents didn't assess their income or didn't care what they said. You know, credit managers complaining that agents don't understand the need for quality sales. Of course they don't. That's not what they're being paid to understand. Yeah, there's a lot of ideas here. There's been a lot of different incentive models. And what I'm never sure of is this the best model and it'll just never be perfect and we can optimize it? Or should we be fundamentally more experimenting and looking how financial service providers disperse and collect credit in these markets and borrowing more of theirs? None of those are going to scale sales quite the same way our model does, but I'm not sure that's a bad thing entirely. They might be much better at scaling quality sales than the model we have now. And so there's a lot of time spent in the report on recommendations for how to address agent issues. I think that's appropriate because I do think we've settled on this model in a way that may or may not be to the long-term benefit of the sector.
Maybe Dan, if I may, on this first tension that you're bringing up, you're saying should we move to kind of the way that essentially MFIs or similar institutions, but obviously one of the things that Donald was pointing out is that one of the other tensions is that the further we push for credit performance, the further away we push potentially from universal access style goals. Yep. And MFIs have notoriously not reached the type of customers that PayGo industry has been able to reach.
Yes, because that's the limits of using a credit-based model for a credit-based model is not going to deliver universal access. And so I think if we all agree on that, then there's a range of solutions to which PayGo has limits, and things like the Rural Energy Access Lab and other subsidy programs are what we need to be exploring to reach people who cannot afford to repay a solar loan. Subsidizing the daily repayments are an important step to that, but again, there's limits to that approach as well. And so that's okay. Lenders need to get repaid. There's no the laws of financial gravity do kick in at some point, and without huge amounts of investment coming into the sector, they're going to kick in harder and faster. And so this is not really an optional discussion, frankly. Donald, I mean, I think highlighted that tension of the mission and the sustainability of the company exactly right. There's nothing I can add to that. It is a real tension and people wrestle with it. But if you don't deal with it, then sooner or later, it's going to be somebody else's problem. So I was going to get to that, so I'll skip that part. And then I just think the piece Harry talked about the deposit, I think is really interesting. We are not pricing in risk all that well as an industry, partly because it's so hard to assess that risk at the point of sale. But there's a customer highlighted in the report who is a school teacher with a regular salary, who has a grid connection, who takes out a solar loan, pays for it maybe 5 times a month, gets called every day by the credit center, and doesn't seem all that bothered by it. And that person definitely should have a solar home system. I'm not sure they should be getting it on a flexible pay-as-you-go loan with a 10% deposit, right? That's somebody who could probably pay a higher deposit because they have grid access, which maybe makes them a bit riskier. They could also be getting a salary deduction as opposed to a very flexible pay-as-you-go loan product. And so kind of segmenting and assessing and productizing that risk a bit more effectively is something I'd love to explore. It's something companies have struggled with in the past because nobody likes to know that their neighbor got a 10% deposit and they have to pay a 30% deposit, right? That creates conflict and friction. But maybe that's one of the hard choices you have to make in actually pricing in the risk at the customer level. And just the very last thing I'll say is, for all of that, for all the fundamental issues, what the report also shows is that company performance makes such a huge difference. There's a great bit about, the difference from company to company in terms of customers understanding loan terms, of how they're assessing and managing risk and working with customers. So I still do think a lot of this comes down to execution, and the better executing companies are doing a pretty good job with it.
Thanks a lot, Dan, for making those great points and asking some hard questions also about the fundamentals of the model. But yeah, we're glad to have partners like Acumen kind of bringing the hard questions. Charlie, before we forget about you, what would you like to add to what's already been said by the companies and by Dan?
Thanks, Oliver. Can you hear me okay? Yeah, I mean, I think the first thing I would say is one of the things I'm really struck by is that it's not actually a clear-cut tension between, if you want a lower default rate, you serve higher population areas with higher incomes. It seems that customer experience is a sort of a third point of what is more of a sort of a triangular relationship. I just flagged the 60 decibels research coming out next week, which is already available online, suggesting that defaulted customers are less likely to be below the poverty line rather than more likely, because it may be that lower income households are thinking through their decisions more carefully and more really committed to completing repayments than those that are higher income. And also, one of the things that really struck me was the high rates of technical issues that were found in the report. I think it was something like 28% in one country and then closer to 50% in the other amongst people who ended up defaulting, suggesting, and again, this sort of aligns with what 60 decibels will be sharing next week, that customer experience is potentially more important than customer profile in shaping defaults. So I think this is a really complex issue, and it's not as clear cut as I thought it was even 6 months ago. The other thing that jumps out is that the picture is very different by country. The social perception of non-payment, and suggesting that social perception of non-payment could be a driver for improving return rates in some locations. And then this point about availability of alternatives, with the research suggesting that if people have alternatives, you should sort of mark their credit score down. And I find that very surprising, because if I was buying an off-grid solar system and I wasn't sure I'd be able to afford it all the time, I'd definitely make sure I had plan B, plan C, plan D. And I kind of feels like a little unfair to judge me for that, for giving myself options. And I do think we need to disaggregate between solar lights and solar home systems. I mean, a situation where a household has two SHS is clearly very different from a situation where someone has an SHS and when they can't afford it, they're using a D-Lite S2. So let's please not lump those two solutions together. Clearly, all the alternatives are only a partial, they provide a partial level of the service provided by the SHS. I mean, other takeaways for me, I think there's clearly room for improvement on the private sector side, as highlighted by the technical issues. But also on the public sector side, it's clearly a really serious point that we want to make sure that results-based financing doesn't incentivize companies to take on excessive credit risk. And one of the things that jumped out to me on that front was the extent to which factors affecting default rate could be identifiable at a group level. We've talked a lot about sales agents and their incentives, KYC methodologies. But then if you look at the risk of factors, if it's flood, drought, macroeconomic shock, then those should all be, doable at a country level, really. And then, even the availability of alternatives, I was reflecting on the fact that we have a lot of multi-tier framework surveys coming out in the next couple of years, and that could give us really good assessment of availability of alternatives, again, at a national or a regional level for large groups of potential customers that could be fed into a risk assessment model. I guess I would close by saying I think there's potential for more data from companies to help to calibrate public funding and make it more responsive and adaptable to short-term events that affect default rates, like, for example, Forex devaluation. I think we would need to be very careful if we're incentivizing companies to go into rural areas and to serve lower income households, that we're not exacerbating their default rates, and interested in exploring how potential data sharing, maybe using some of the PAYGO perform metrics, could help to monitor default rates for RBF portfolios and adjust RBF amounts accordingly, so that we don't end up, kind of crippling companies with high default rates as we subsidize them to expand access. But also very mindful of the complexity of that, and think we need to look at ways of automating to keep transaction costs and admin burdens down as we explore that possible route. And then I think I would close by just reiterating something that Christine Singer mentioned in the chat and Dan brought up as well, which is that we need to be clear-eyed about the limitations of the PAYGO model, right? It's not appropriate for every company. It's a very distinct capacity, skill set of systems and processes that isn't always going to be appropriate for companies, especially those that are less well capitalized or more risk averse or smaller. And then, even just looking at pay-as-you-go and its potential to reach the worst off, I think we need to keep in mind that at some point the costs and risks of lending get so high that lending no longer makes sense. And at that point, we need to reconsider the possibility of just using subsidized cash sales. I mean, let's keep in mind that the effective interest rate on a paygo loan is averaging 40% annual equivalent rate. So it is high, right? And if we can drop that, then that can drop the overall cost significantly. But then also the possibility of subsidized energy as a service as well. You know, the report points to the fact that the longer the repayment period, the higher risk of default, the higher risk of payment fatigue. I'm very interested to understand the extent to which that is linked to the fact that it is seen as a loan, and the idea that end users own the asset, and whether, you know, if the end user doesn't own the asset, maybe they're fine paying on a service basis for a longer period. And all the importance of communication and just how the proposition is made to the customer, the potential to make that proposition in a very different way that gets people comfortable with paying their energy bill month in, month out, week in, week out, the same way people do when they're connected to the grid. So, you know, in short, the research is really eye-opening, but it points to a nuanced and complicated picture, and clear room for improvement on both the private and the public sector sides, I would say.
Agreed, and thanks a lot, Charlie. And yeah, I mean, I think agreed on the fact that there comes a point where if we're subsidizing these products, we need to look at the cost of debt versus the cost of the product itself. But I was also kind of bringing us back to the kind of how do we make paygo work in the cases where it can work? Obviously, there's a lot of RBFs coming online, and there's a lot of subsidization through paygo companies. And as Harriet pointed out, in some cases, maybe encouraging companies to enter the paygo model to be able to benefit from these subsidy programs. I was kind of wondering if I'll start probably with Don and Harriet, but essentially, if we're talking in markets that are going to be increasingly benefiting from these types of result-based finance subsidy programs, can these programs be designed in a way that they are incentivizing good customer outcomes and good credit situations for the companies? Is it their role? And if so, like how do we do that well going forward? Maybe if Harriet or Don, or one of you wants to jump in first. I think you're both currently benefiting from some of these RBF programs, including in Uganda. Not both at once.
Do you want to go first, Harriet?
Okay, let me go first. RBFs actually, to us as a small company, RBFs are coming in to subsidize the customers, and to me, I feel that there's less concern about us, the companies that are taking on all the risk in doing this business. RBFs, where I find that products are subsidized by over 50%, will lead to, of course, higher sales, higher uptake of the products, and it will address the affordability and the access. Affordability and the access, customers will be able to pay less for the product. Though the company, as you collect these meager cash flows from the customers, as you have to operate, and then the debt burden, RBFs, I don't know how, I'm not quite sure, but let me say that what I think can work is that instead of like having RBFs whereby we are subsidizing a lot for the customer, there should be sort of like a planned maybe withdrawal period, yeah, a planned exit that customers get to know the real price of the solar lights and they are able to pay for them. Otherwise, if we continue with the RBFs and at this level whereby we are reporting default of about 40%, now we just imagine a situation whereby there will be no subsidies. What will happen? So I think RBF design can be tailored a bit, adjusted a bit, and let that either 50% or 60% be divided into two. If we can have the partner, the implementing companies, have also a bigger incentive it would maybe strike a balance between, it would risk them a bit other than having all the incentive go to the customers. Also, one thing I've realized about the RPF, we are talking about PEGO, but it's just on rare occasions that the RPF partners, that they respect the terms of the RBF engagement. So you find that there are some delays on the partners' side, which always cost the companies. And yeah, some of these are not reported, maybe, but RBFs and sustainability of private sector companies, I don't think we can have there a good marriage.
I think you've raised several interesting points. Like the risk is still taken on by the company, which is a risk of sustainability. There's also the continuity of the subsidy, or whether that program shut down, and what happens when the subsidy disappears. And I think you've also mentioned in the end kind of specific nicks and knacks with the implementation and how that actually operates on the day-to-day versus what's designed on paper. Maybe Don or Delight is, I believe, benefiting from the same RBF program as Finesola in Uganda. Does what Harriet say resonate? Do you have similar thoughts on this topic?
Yeah, definitely. It definitely resonates. There's definitely, I will say maybe at the outset, I do think RBFs are excellent, are an excellent policy tool that we can use as I guess, a society to drive towards the goals that we are all signed up for, these SDG goals. I think without that sort of support, it's even with the support, it's going to be very difficult, but certainly without the support, they would be impossible. These aren't all going to be commercially viable customers that we will reach through whatever route to market we go with. So I will say RBFs as a tool. I've also noticed over the last few years, they are improving. The way they're structured has taken a lot of the feedback in and improved. So I'm excited as we learn from the UECCC and Uganda, and I know with even more learnings through the Beyond the Grid Fund has kind of implemented more and more learnings as they've done other funds, and now DARA is kind of trying to pull the best from each. So I am confident that as a funding kind of ecosystem, the learnings are there and that the RBF systems are getting better, which is great. That's not to say that what Harriet says is very true. It still comes with, it's like, I don't know, it's a bit like a drug. It is good, but it's very dangerous. It can be great to stretch into areas where you maybe not weren't possible before, and to give that subsidy, pass it on and have higher sales, but obviously dangerous as it will lead to these cliffs at the end of the RBF programs. It will extend credit to customers who you previously wouldn't have. So what happens to those customers when it comes time to replace or upsell their product? Do they go back to the darkness, which I'm assuming most people here would think is a terrible outcome, to have given someone the tantalizing kind of experience of having a solar home system for a few years. But if they can't afford the next one when this one breaks, what kind of happens? So I think there's still a lot of bigger picture questions to answer about RBF. And I really agree with what Charlie was saying, that in too many of these conversations, we use these frameworks and tier 1, sometimes they're even saying tier 2 minimum. And that just doesn't, it doesn't really always sit with the reality of our markets, where even tier 1 is out of reach to a lot of customers. So what can we be doing for those if we want to have universal access to energy? If someone, even at a subsidized rate, can't get access to tier 1, then we need to be looking at, other products, portables and small cash products that can bring everybody up to a floor that we want to achieve. So I will say as well, maybe one of the other areas, and I know, Harriet, you mentioned that if we are thinking about RBFs and we have public funding or concessional funding coming to the industry, I do think some portion of it needs to be apportioned or thought about. What about the additional risk for companies? So whether it's a kind of a first loss facility as the credit risk is increasing, or if it's just some more tilted towards a split between the supply side, so giving it directly to companies to decide how much subsidy they should pass on. I think there's still refinements to the approach that can be taken, as well as on the reporting side. I really agree with some of the newer approach where we're looking at quality connections, so that it's not just number of units sold, it's is this customer still using the product in 3, 6, 12 months. So overall, very positive, I have to say. I think it's a great step forward just for the industry and just for the mission that this industry is trying to achieve. And I trust that there's a lot of people thinking about how to improve them, and I know that there's going to be continued improvement as we learn what works best and what are the longer term implications of how we've structured previous programs.
Thanks a lot, Donald. I'm going to get told off if we don't switch to Q&A soon, so I just want to give a chance to Charlie and Dan to get time to respond. So maybe first, Charlie, talk about people who are looking at how to improve RBF and RBF design. Maybe for you first. I think, Dan, you made a point in the beginning. You'd also like to talk about like what investors' role can be in this space. So once Charlie's responded, maybe if Dan, you can jump in with how you see like the investor's role, private investor role in this space, and then we're on this question. But Charlie, over to you first, in response to what you've heard from the companies and maybe telling us a bit about your thinking at the World Bank.
Thank you. So first, I would just say it's a risk that we're very mindful of. I mean, the fact that we're dispersing all of this RBF funding and the only data that we get back really is what sales are taking place where. We really have very little visibility into what happens post-sale, and that is a concern. Technically, companies are supposed to report to most RBF programs if they have defaulting customers, and in many cases those defaulted products are not eligible for RBF, so RBF would be clawed back. But I don't know how much that actually happens in practice. That's one thing. And secondly, what happens when you get to end of life? The point that Harriet was making about, if you've heavily subsidized the system, whether it's because of default or not, are you actually getting a permanent connection? Because that's what we seem to have convinced ourselves we've paid for. But then I think there's a fair chance that there's a huge drop-off rate over 5 years, and the higher the level of subsidy, the higher the chance that it's not permanent access that is being achieved. So this is definitely an area of interest for us. I would come back to some of the specific suggestions in the report, one being that we shouldn't subsidize down payments. Not aware of many programs that do that, so I was pretty happy to see that we're not doing that. And then longer repayment periods increase the likelihood of defaults. I mean, again, I'm not aware of many RBFs or indeed any that have specified that they require longer repayment periods. So I don't know if RBF is really being used to incentivize stretched repayments at this point. That said, I do want to keep the door open for the possibility of non-ownership models, energy as a service models, and indeed the possibility that at some point the costs and risks of lending no longer make sense, and even a subsidized cash sale could be a preferable solution, a cheaper from a public funding perspective solution to deliver access. And then this last point about the suggestion that subsidies should focus on daily or monthly amounts. I had some sort of queries about that. I mean, that actually means that the public funder takes more risk, because we now run the risk of paying out for 18 months of payments side by side with the customer, and then the customer going into default, and we haven't got the permanent access, the completion of repayments that is the understanding. That's what we will get when we're subsidizing a cash sale 100% upfront. And then, of course, whilst I see all the advantages of paying out based on consumer payments, that means that you're managing a huge number of tiny payments, comes with higher transaction costs, requires a higher degree of automation, ideally the presence of mobile money, and just may not be possible for all companies, for all customers, or in all locations. So whilst I can see its appeal, I think there are other factors in play when we are designing RBF, and our role at the World Bank and ESMAP is not to tell governments what to do, it's to present them with the pros and cons of options and assist them with making informed decisions regarding some of these trade-offs. So it's really not up to me to take a view, but I think discussions like this are really helpful just to help us hear from companies about their perspectives on these issues and to bring that into the advice and support that our colleagues provide to their government counterparts. So yeah, I would just close by saying I'm really excited about the possibility of improving the data that is available to public sector actors as well as private sector ones, so that we can all monitor and manage default risk better. I don't think it is a concern just for the companies, because the more public funding coming into the sector, the more public funders have a stake in the sector, and the more they too need to be monitoring this risk. I mean, ultimately, if there's a really high default rate, our RBF is failing, right? Failing. So there is a need to look at improving data, improving automation to support agility and flexibility in RBF design, to enable them to be more responsive to change as it occurs, especially with FX devaluation or with droughts and floods, being able to respond to that quickly. These, I think, are some of the key areas that we need to be looking at, in addition to the point about end of life and making sure that we are using long-term public financing that is delivering long-term off-grid access, and not just solutions that work for a couple of years.
Thanks a lot, Charlie. Dan, over to you, and then Kat, if you're still there, I'll just let you pop in after Dan if you're still on the line.
I'll be really quick, which is just to say, I think there's a similar dynamic to somewhat what happens at the credit and the sales level with investors, which is, equity investors are motivated by upside and by growth. And for a long time, I think, kind of hand-waved at some of the credit issues, and particularly when it came to looking at revenue and the way revenue was recognized, you wanted to see a growing portfolio without necessarily looking at the full quality of that growth. I think that's changing, but also that's changing because the funding of the sector is shifting more and more towards debt. And with the rise, particularly of off-balance sheets instruments, you can't hide it anymore, right? So a third party is now paying for the portfolio, and so they're paying for the quality, and whatever's left over is what the company has to live with. And so I think that has been, what African Frontier Capital and others have done is going to be and has been a key driver of credit quality going forward, because they are pricing it in quite effectively, right? And so I think there's more that could be done there. I think lenders could probably do a bit more to be embedding some unified terms and reporting terms when it comes to credit metrics into lending. But there's been a lot of success here, and there's been a lot of growth here, and I think I've at least been encouraged by that.
Definitely agree. And actually, I think for those of you who will join us at the AGM in June, we also have some new suggestions to share with the investor crowd, especially around PAYGO indicators and how they might be integrated into terms. Kat, are you still there? And can you jump in to tell us a bit more about the study and the webinar that you're launching next week, which I think Charlie or Dan already alluded to?
Yeah, thanks for the call out, Charlie, and thanks everyone for sharing all your thoughts and questions. And I think particularly companies being up for learning together and us talking to your customers. But yeah, just very quickly, so this Keeping the Lights On study talked to active customers who are defaulting, so they're missing payments, but they're still on the books. 60 Decibels recently talked to past customers who defaulted and had their product repossessed and taken back. We called it a falling behind, so we're a bit worried about this group who might end up almost worse off than the leaving no one behind group that we talk about a lot as well. D-Light was part of those studies, so Donald might have some hot takes for us, but I put the links already in the chat. You can find a suite of other reports and insights as well, where we talk to active customers, where we talk to companies about their consumer financing practices. And I suppose just in summary, yeah, unsurprisingly, lots of complementary insights, which we'd expect. Main reasons for defaulting and defaulted customers was financial constraint. But we saw some other things like customer challenges, dissatisfaction with the product and/or customer service, and definitely a lack of understanding of the payment terms as well. So our report is out already. We look at who these customers are, what their experience was of the default and repossession process, why they fell behind, and then the impact that repossession has had on them and their current energy access status. So we'd love you to join next week for the webinar. That link's in the chat too. And we'd love to keep further discussing all of these things, all these different types of groups of customers, and making sure that as companies, as investors, as researchers, as sector bodies, that we're all working together to hopefully support customers to get energy access.
Thanks a lot, Kat. And yeah, I've had a look at the study. Definitely some great findings in there and complementary, but also indeed like some things that are slightly different. Might also have to do with the types of companies we've been able to talk to. But I think you have a wider group of companies you were able to talk to. So I think some interesting insights for comparing. I think anyone who's on the webinar today would learn a lot joining the 60dB webinar next week. And I know I've left almost no time for questions and answers. I said there's been a lot of back and forth in the chat. I can kind of see it oscillating in the bottom right of my screen. But are there any questions that haven't been addressed that maybe some of our panelists or Altai or even Kat can help answer?
Yeah, thanks, Oliver. I think we've seen quite a bit of responses to most of the questions, but I think one that came up, I think while Harriet was speaking, was really to engage around, if not PayGo as the payment system, what would be more preferable? Is it more of upfront sales, or is it more energy as a service models? And I've heard Charlie kind of respond to that aspect, but I wonder if there could be any responses either from Donald or Harriet on that. And then the other one would be around, and again, we've touched on this, is it more around monthly and daily subsidies to respond to the issue of variability of incomes? Because, at the end of the day, we talk about affordability is a major challenge, but at the end of the day, it's really more about income instability. So could that be a more effective way to respond to the challenge? And yes, again, this has kind of been touched on among the different speakers as the discussion went on, but I think those are the only two I've seen without necessarily like a direct response in the chat. And also just to mention that I could run the poll question at this point, even as we get any reactions to that. So this is pretty much in response to what some of the topics that we've discussed and that the different panelists have spoken about. So, if we were to look at, some research topics to explore how to respond to these different challenges, what would be some of the more interesting areas that you would want to understand to drive the sector forward? Yeah, great. I'm seeing some responses already.
Thanks,
yeah.
Maybe jumping back to the couple of questions that were in the chat, in particular, I think the first one, I think Harriet, it was in the context of Harriet moving to PayGo to be able to benefit from the RBF. I think we didn't. Yeah, I think that the options of what might be possible have been addressed. I'm kind of wondering though, Harriet, if you could share a bit more about what you were doing prior to the RBF. Was that just cash sales then of solar home systems?
We are doing a mix of cash and PayGo.
Okay, but so prior to the RBF, you were not doing PayGo though, right? Is that correct?
I really think that if it wasn't for RBFs, I wouldn't be doing PayGo.
I'm wondering from Dan and Charlie, this statement of if there wasn't for RBFs, I wouldn't be doing PayGo. How does that kind of resonate with, the design of these programs and their effect on the market?
Well, if I could just jump in, I mean, I don't think we should detract from pay-as-you-go's contribution to energy access as well, right? I mean, we've been critical of pay-as-you-go for much of the last hour and a half, and rightly been focused on the challenges with the model and how they can be addressed. But pay-as-you-go has been critical to making products affordable and critical to enabling people to access a higher level of service than they would have otherwise been able to enjoy. So access to radios, for phone charging at home, TV, fans, all of it. So I think we need to keep that in mind as well. I mean, it always makes me a little nervous, Harriet, to hear companies making business decisions entirely because of public funding schemes. You know, it's a fine line, and the balance we tried to take in the market trend report was that companies really need a core commercial business that sits alongside their subsidized first-time access business. But I recognize that in practice, you know, RBFs are a major opportunity for companies, and can enable them to get a foot in the door and to, you know, to build scale, to improve unit economics, margins. And, you know, in practice, it's a lot more messy than that. And there may be times where, you know, being responsive to what an RBF wants really does make sense. So I do understand why you've done what you've done. But I just think we need to tread a little carefully, because anything that is dependent on public funding is risky, because public funding is fickle. It doesn't last forever. Amounts change, programs end. And we just need to keep that in mind, that, you know, whilst we would like to make it longer term and more predictable, and to give companies more advanced notice of changes in the way RBF is being delivered, that's not always feasible, you know, with new governments coming in, or changes in personnel at the REAs, people wanting to do things differently. And we are pushing very much to improve the predictability of results-based financing, and to make them as long-term and as stable and reliable for companies as possible. But I would say that they are not still reliable and predictable entities today.
Thanks, Charlie. Dan, I saw you'd also unmuted originally.
No, I think Charlie covered that in better depth and detail than I would have. Right, it's a significant risk. Companies may choose to take that on, but that risk is real, and perhaps it can be made to work, but perhaps it cannot. So,
thanks a lot. I think, and I'll hand back over to you, and I think we can close off. But I would like to say thanks a lot to our panelists. I mean, these conversations are always super insightful. So thanks a lot, Harriet, Donald, Charlie, and Dan, and over to you. I believe you.
Sorry about that. Yes. Thank you so much to everyone, Oliver, Dan, Charlie, Harriet, Kat, and Donald, for sharing today. Thank you as well to our research partners from Alta. Oh, yes, you can't see the survey results. I have just run that as I close out the session. So, and I will share this via email as well. But yes, and thank you as well to Gopika, representing RBO and Endev, who supported the delivery of this study. We should be launching the report later this week, and we'll send that over to you via email, and look out for more from us as we go along. And we're all welcome to join the 60dB webinar next week. So thank you all so much, and have a great evening stroke day.
Thanks, everyone.
Thanks, everyone. Goodbye.
Thanks. Bye-bye.
Thank you. Bye-bye.
Yeah, thank you, and bye.
Bye-bye.